This is going to blow your mind. Today, we're witnessing a seismic shift in global finance. The U.S. bond market, once considered the bedrock of economic stability, is showing cracks. For decades, investors believed in the unwavering strength of U.S. bonds. But now, China's strategic financial decisions are challenging that belief. Recent directives from Beijing are causing ripples that could lead to a financial tsunami. In this video, we'll unravel the events leading to this potential crisis and what it means for the future of global economics. This stuff is way more interesting than it sounds, especially when it involves America's insatiable appetite for debt and China's cunning financial maneuvers. You see, the relationship between these two giants is like a high-stakes game of chess. For decades, the United States has been the world's biggest borrower, racking up trillions of dollars in debt. This debt is primarily financed through the issuance of U.S. Treasury bonds, which are essentially IOUs from the government. And for decades, countries like China have been more than happy to lend us money, buying up U.S. Treasury bonds like they were going out of style. This has allowed the U.S. to finance everything from infrastructure projects to military expenditures. Why? Because these bonds were seen as the safest investment on the planet. They offered a reliable return with minimal risk, making them a favorite among global investors. They were the bedrock of the global financial system, a surefire bet that always paid off. Investors could sleep easy knowing their money was in U.S. Treasury bonds. But here's the thing about love stories. They often take an unexpected turn. Just when you think everything is going smoothly, a twist comes out of nowhere. And in this case, the twist is that China's starting to rethink its relationship with U.S. debt. They're diversifying their investments, looking into other assets like European bonds and gold. They're not breaking up with us entirely, but they're definitely seeing other assets. This shift could have significant implications for the global financial system. And that, my friends, should have everyone a little bit worried. The dynamics of global finance are changing, and we need to pay attention. Stay tuned as we explore what this means for the future of international economic relations. So why is China suddenly getting cold feet about U.S. bonds? This is a question that has been on the minds of many financial analysts and policymakers around the world. The relationship between China and the United States has always been complex, but recent moves by China suggest a significant shift in their strategy. Well, there are a few reasons. To start with, the global economic landscape is changing, and China is adapting to these new realities. The days of China being the world's factory and relying heavily on exports to the U.S. are evolving. First off, China's economy is no longer the unstoppable growth machine it once was. The rapid industrialization and urbanization that fueled its growth are slowing down. The country is now focusing on sustainable development and reducing its reliance on external markets. They're facing their own economic challenges, and they're starting to prioritize their own financial stability over propping up the U.S. economy. Issues like a housing market bubble, rising debt levels, and an aging population are forcing China to rethink its economic strategies. Second, China's getting a little tired of being America's banker, especially when the U.S. keeps throwing its weight around on the world stage. The trade wars, sanctions, and political tensions have made China reconsider its financial commitments to the U.S. It's kind of like lending your friend money to buy a new car, and then having them constantly criticize your taste in music. The relationship becomes strained, and the lender starts to question the wisdom of their generosity. At some point, you're just like, you know what? Keep your damn money. This sentiment is becoming more prevalent in China's approach to its financial dealings with the U.S. But here's the real kicker. China's not just passively selling off its U.S. bonds, they're taking a proactive approach to diversify their investments and reduce their exposure to the U.S. financial system. They're actively looking for alternative investments, and they're finding them in places that directly challenge the dominance of the U.S. dollar. This is a strategic move to ensure that they are not overly dependent on any single economy. This includes things like buying up gold, which is seen as a safe haven asset in times of economic uncertainty. Gold provides a hedge against inflation and currency devaluation. Investing in their own currency, the yuan, is another critical strategy. By strengthening the yuan, China aims to increase its global influence and reduce the dominance of the U.S. dollar in international trade, and forging new trade partnerships with countries that are eager to ditch the dollar. These partnerships are not just about trade, they are about building a new financial order that is less reliant on the US. This strategic shift by China is reshaping the global economic landscape and challenging the status quo. Now, you might be thinking, so what? Why should I care about US bonds in their current state of pressure? If China doesn't want to buy our bonds, someone else will. After all, the US has always been a reliable borrower, right? And you'd be right, to a point. The US has a long history of being a safe bet for investors around the world. There are still plenty of investors out there who are willing to lend money to the US government. The global financial market is vast and diverse. But here's the catch. They're demanding higher interest rates. This isn't just a minor inconvenience. It's a significant shift in the financial landscape. Think of it like this. When everyone trusts you, they'll lend you money for cheap. It's like having a stellar credit score. But when your credit score takes a hit, you're going to have to pay a premium to borrow that same amount. The trust factor diminishes, and lenders want more assurance. And that's exactly what's happening to the US right now. The trust that once made US bonds a no-brainer investment is wavering. As China and other investors become more hesitant to buy US bonds, the cost of borrowing for the US government goes up. This isn't just about China, it's a broader trend. This might not seem like a big deal, but it has huge implications. The ripple effects of higher borrowing costs can be felt across the entire economy. Higher interest rates mean higher borrowing costs for the government, which means less money for things like infrastructure, education, and healthcare. These are critical areas that affect everyday life. It also means higher interest rates for everyone else, from businesses trying to secure loans to individuals trying to buy a house. The cost of borrowing affects us all, from the largest corporations to the average family. When borrowing costs rise, businesses may delay expansion plans, and families might postpone buying a new home or car. This can slow down economic growth and lead to a more cautious financial environment. Economists and financial analysts are closely watching these developments. They understand that the health of the bond market is a key indicator of the overall economic stability. Policymakers are also concerned. They need to balance the budget and ensure that the government can continue to fund essential services without incurring unsustainable debt. The pressure on U.S. bonds is more than just a financial issue. It's a societal one. The decisions made today will impact future generations and the overall well-being of the nation. As we navigate these challenges, it's crucial to stay informed and understand the broader implications. The state of U.S. bonds affects us all, and being aware is the first step towards making informed decisions. But wait, there's more. Remember how we said that U.S. Treasury bonds are the bedrock of the global financial system? Well, if that bedrock starts to crumble, the whole damn house of cards could collapse. See, U.S. bonds are used as collateral for all sorts of financial transactions around the world. They're like the gold standard of collateral, the thing that everyone agrees is worth something. But if China and other investors start to lose faith in U.S. bonds, that could trigger a domino effect, leading to a global loss of confidence in the U.S. dollar and the entire global financial system. We're not talking about some abstract economic theory here. We're talking about a potential financial meltdown that could make the 2008 crisis look like a walk in the park. We're talking about bank failures, stock market crashes, and a global recession that could last for years. And all because China decided it was time to reevaluate its relationship with the US dollar